Good morning, ladies and gentlemen. Today we have another one of our shows. Our co-host, if you will, is Pat Boland. I don't think I need to give him an introduction for anybody that's watched business news over the last couple decades. Pat's been a stalwart in Canadian business news. Pat, thanks a lot for joining us again.
Good to be back. Particularly excited to be on with Mark Lackey, our guest coming up, because he and I used to do TV together.
Yeah.
Well, Pat. Yeah, Pat, we did probably about 100 shows together, including both networks, BNN and the Sun News Network. So I always enjoyed going on with Pat. It was terrific.
Yeah, me too. You got it coming from both sides this time, Pat. You got a couple of your usual guests.
Yes, exactly. And a real pleasure to be on with you guys.
Yeah, well, as Pat mentioned, Mark Lackey is joining us today. Mark is the Executive Vice President at CHF Investor Relations and CHF Capital Markets. As Mark was mentioning, he had been on business television a lot talking about the markets, and we're really happy to have him on. Thanks for joining us, Mark.
Great to be here.
So, let's get right into it, guys. In the chat before we started, Pat was mentioning something about a blog that you recently posted, Mark. Why don't you set that up for us, Pat?
Yeah, he was talking about palladium prices, and this was back at the end of March when they were around $750, and he had a forecast on palladium for $800, I believe it was, Mark, to the end of the year, and $900 in 2016.
Right.
And similar discussion on silver as well. A lot of it revolving around the economy in Asia. And Mark, maybe give me some background on that one, because I don't know whether we necessarily agree.
Well, I mean, Pat, I think that we agree more than you think. I think that ultimately the overall GDP numbers are not quite as critical to the demand for palladium as the production of automobiles. And as I pointed out a number of times, when people look at both China and they say, well, we've seen some slowdown in GDP growth, we're now looking at 6.5 to 7 as opposed to 9 to 10. That's accurate. But the area that's still growing quite rapidly has been automobile growth. And this year we expect 25 million vehicles to be built in China. And the important, as you know, the importance for automobiles is that palladium is used in the catalytic converters. So while I don't know if it's such a great situation if you're in the lumber market right now, Pat, because housing in China clearly has slowed down, and consumer semi-durables. But if you're in the automobile area in particular, it's actually doing extremely well. So again, I would suggest that I saw something the other day where somebody said, oh, all the commodities trade the same way, it's all related to the US dollar. I would suggest that you have to look at every commodity on an individual basis. So I like palladium also on the supply side, and we talk about that later.
And Pat, you had some conflict with that analysis, or you thought you had a different opinion?
I did, but it's something you and I have shared. Mark makes an excellent reference to the dollar having an effect on all the commodities, and we've talked about that at length in the past. But here's what I'm seeing is that the dollar started to falter a little bit, and yet we haven't seen the bump up in the commodities that might be expected with that, or competing currencies for that matter. So I don't know whether the dollar story plays out as well, although his supply and demand on the automotive side for palladium is an excellent one.
Actually, Pat, I think I was just doing some chart work yesterday, and you want to take a look at the U.S. dollar as it's topped out. It went from 80 in the index in May of last year to a high of a little over 100, and now it looks like it's coming off from there. And as it's been coming off from there, watch, there's been an uptick in the price of gold and an uptick in the price of oil. I haven't done all my work on other commodities, but I think you'll see a little turnaround. It's not like it's gone for, the market's gone down quite dramatically, Pat, or in the case of the U.S. dollar, up quite dramatically. So I think we're in a flux period where we're kind of in transition from one trend to another. What do you think about that, Mark?
Well, I think that one of the things, Pat, you and I have talked about on the networks over the years is that the correlation to the U.S. dollar, the inverse correlation to commodities, isn't quite as strong as it used to be. And one of the reasons is you're getting more and more of these deals where people are not using the U.S. dollar. Look at the Russian gas sale to China. That's not going to Russian currency, to U.S. currency, to Chinese currency. They're doing it directly. And look at the Chinese setup here in Canada recently, where you're going to be able to take Canadian dollars and deal in Chinese currency. You're not going to have to necessarily go through the old situation where you went Canada, U.S., China. So I think that some of that's starting to unwind as well to some degree. Obviously, there's still going to be some negative correlation, but I don't think it's going to be as strong, given that, first of all, the world has changed. And Asia is where the growth is still going to be over time for commodities as opposed to, say, Europe or even the United States. So I do think that inverse relationship's not as important as it used to be.
And I think, just like you said earlier, Mark, that you have to be kind of individually, you can't sort of just throw everything into one basket. I am noticing a fairly close correlation right now between the U.S. dollar and gold, for example. I think you're seeing a similar thing with silver. Some may be impacted more than others, but I still think there's going to be a correlation there on certain commodities, gold for one of them.
I still think that gold relationship's there, Alan. I agree with you. But I think as more and more gold is bought by India and China, I think that's going to be somewhat less exchange rate sensitive. It's not like there's not going to be a relationship. It's not like all of a sudden they're going to be completely uncorrelated, like, say, managed futures contracts are completely uncorrelated to the stock market. I've done that kind of work, and that's actually true. So, but I do think the world is changing, and I think that the U.S. dollar is going to become less and less the reserve currency.
Now, lately, Pat and I have been having some discussions about the U.S. dollar. I think it's rolling over. Pat comes from it from a different perspective.
Yeah, only because, I mean, the rollover is a return to the mean, if you will, and I don't think that's unexpected. It's had a really steep run, and it's just giving back some of those advances. But as the economy expands in the United States, and it seems to be doing that, then you are getting more and more pressure to increase interest rates, and I think that that will remain a primary driver of demand for the U.S. dollar. It's not like the U.S. dollar is going to go back to where it was.
Now, there's something I wanted to talk about, and it's something that's got me. I think we're at a bit of an inflection point here with the big cap stock market. We've talked about the U.S. dollar. Obviously, U.S. stocks or equities are closely tied to that. I'm seeing the U.S. equities as pretty rich right now in price for perfection. S&P 500 and the Dow is trading at 17, 18 times earnings, but looks like earnings, they're talking about a possibility of an earnings recession and single digits, low single digits kind of growth in earnings. So when you've got earnings at, price, the market price for perfection, and a possibility, a realistic possibility of a earnings recession, that's got me concerned there might be a fairly stiff correction coming here for equities. What do you guys think?
Well, Pat, I'll go first. In fact, Pat, we've been advising some of our clients because we think the Canadian dollar doesn't have too much more downside, maybe some in the very short run here. But we also look at the valuations. We agree with you, Alan. And theories like pharma, we've made quite a bit of money, but we're not going to stick around and try to get the last dollar. So we've been advising people actually to take some money off the table out of the U.S. market, and it depends on the sectors too, again.
Absolutely.
But you're right, some of the sectors are really stretched in valuations, and that's where we have actually advised people to bring some money back to Canada. If you don't want to put it in the market here yet, fine, at least have some cash available. And we've also freed up some cash in the U.S., because we think there's still some good opportunities there, but on balance, I agree with you. I'm a little bit concerned that valuations are stretched here at this point in time. And with this high dollar in the U.S., it's certainly hurting those companies that rely on foreign earnings.
Another one you might want to take a look at, Mark, is New Zealand. They've got very similar economics to us with as far as natural resources, but they're actually balanced. They're expected to balance their budget this year. That, I think, is a very good play against the U.S. dollar. I am also looking at big cap Euro, big cap Asia. I just think right now you got to be a little careful with the U.S. stock market and the U.S. dollar.
And I think you and I had that discussion before, Alan, where I think that there's increased volatility, and Mark makes an excellent point. There seems to be some kind of sector rotation that's going on underneath in the stock market, and that's often accompanied by volatility. The earnings recession that you're talking about is exactly what Mark addressed as well, in terms of those big American companies that have so many foreign assets repatriating those U.S. dollars. It's going to hurt this year with the strong U.S. dollar.
That's what I'm thinking, Pat. And so, you've got a market here that's, priced for perfection. And I think you got to be really cautious. But having said that, I always think that there's something out there that you can be investing in. And like I said, there's some. If I had big positions in the U.S. stock market right now, I'd probably looking outside there. But I also think the U.S. dollar is going to come under pressure, and that's going to be good for gold and silver and a few other commodities. What are some that you're following, Mark, that you're bullish on?
Well, certainly in the small cap area, we've been following companies like Exelon, Mexican Play, and we've also been looking at recently at Impact Silver, which is a small cap player also in Mexico, because they're pure silver plays. And silver, as you know, is a byproduct for a lot of people. The big cap guys are followed pretty well. I think everybody knows them. We follow them as well. And I think that we see some upward movement here in silver, even irrespective of just the U.S. dollar aspect. We see some increasing supply or demand issues on the silver side, where particularly in technology and healthcare. And we also see that there's been a lot of silver companies that have delayed some of their silver, and the byproduct area. If you're not getting as much lead produced, as much copper, then not as much silver comes forward. So, in the small cap area, we've got a few like that. We also play some of the big caps, and on the gold side, there's a whole host of companies I'm following there as well.
Before you get into the gold picks, let's unravel that silver story a little bit. And I'm always, Mark, I tend to be a supply and demand kind of guy.
Right.
Is usually not my first argument. It is usually supply and demand that I get bullish on. And you've made some great points there. I think another one that's important is that, the silver stocks, there's not a lot of them. Finding good quality silver stocks is challenging, and there is a nice community of investors that follow those silver stocks. So I agree with you. One of the ones that I follow closely is Bear Creek Mining on the silver space. They've got a couple of wonderful deposits down in South America. I also follow Fortuna Silver. Now, they're a bigger silver company, but I've been following them since they were $1, so they've done very well, and they're a very well-managed group. So, Pat, do you follow the silver space?
Yeah, and in fact, Mark wrote about it in his most recent blog, talking about electrical demand for silver, better conductor for things like cell phones, but also jewelry expansion in places like India, and then on the supply side of things, taxation as well as regulation. And when he looked at that, he mentioned already Exelon Resources as well as Impact Silver. But one other one that I was looking at, Mark, and I'd love to hear more on the Morro Bay resources. I'm not familiar.
Yeah, Pat.
Hey, a little bit there, buddy. You got the question.
Morro Bay that's a client of ours, and it's a smaller player, but they've got a very interesting play in the Durango Silver Belt in Mexico, and interestingly enough, you had just mentioned Fortuna before. That, of course, is a Mexican play, and Bear Creek. I follow both of those as well, Alan. And Morro, a very small player, probably not as well known to a lot of people, but we really like the project and the management team. And so again, for people who are looking at kind of a micro cap play, this is one they should probably put on their screen, take a look at, and get your own view of the fact that this is one that could easily have some near-term production, and you don't see that too often on these micro caps.
Is that the key milestone that you're sort of looking for as a catalyst to see it some aggressive growth for it, Mark? Is that what you're looking at there?
Yeah, Alan, I have to say this, that the one thing that I have probably changed in the last few years is that I haven't been playing quite as many greenfields plays as I used to. I still play some when I see good management and some of the companies you've introduced me to, for example, but, probably don't play as many as I once did, because investors who will play this space are generally looking for people to have production or near-term production, because then they feel like they can see the cash flow, they can see the growth, and they're not quite as concerned if maybe the commodity price doesn't recover as quickly as I suggest it will.
Okay, but then here's my question to Morro Bay then, if I may then, Mark. If you're looking at that, traditionally, Durango has been shallow deposits and shallow mining.
That's right.
This will be deeper, as I understand it. What's the timeline on that?
Well, I think that, they could get certainly some production out, within the next 6 months to a year. So, and I mean, I think initially they probably take out some of the shallower silver that's there. To get to bigger depths, you're right, that would take somewhat longer. But I mean, this is a case where I think you go out there and you produce some to begin with, as opposed to some people, Pat, who want to hit the big one and produce it first. You're always better to generate some cash flow from the shallower side first and then go deeper, and that's really their strategy. I think it's kind of along the lines of, what some of the people did up in Northern Ontario in the last 10 or 15 years when they decided to go deep. They still produced initially from the shallow runs, which may not give you tons of cash flow, but at least you're not going to be into worrying about dilution to a large degree then.
Is this one of those situations, Mark, where the deeper stuff is higher grade?
Exactly.
Okay.
That's exactly right, Alan. It's kind of like Red Lake, if we could kind of make an analogy.
Okay, perfect. So you've got some low grade up in the system, and as you get deeper,
that's right,
things get narrower but much higher grade.
That's right. That's exactly right.
I got it. So, well, when you put it into that analogy, Red Lake is one of my favorite places to look for gold. So if I can find a similar silver story, I'll definitely do some homework on it, Mark.
No, right. I think that, look, there's a number of interesting, mid-cap and smaller silver plays, but on balance, there's not nearly as many as there are in gold. So I keep saying to people, on some of these commodities, there are so few players relative to once there once was. I mean, just as an aside, I used to follow 65 uranium companies. Now I follow 6. So, if you get a movement in these commodities, you're going to have the advantage that there's going to be a lot more money chasing a lot fewer companies. And I do think that situation will transpire over the next few years.
Now, you mentioned a very interesting thing there, Mark, and it's something that I've talked a lot about. And Pat, I think you'll be really interested in this as well. As we've had a tougher market here, and we've seen this before, I think we're seeing a bit of a consolidation of focus. In the past, like Mark had mentioned, you could have multiple uranium plays at one time. But when you really do your homework, you're narrowed down to about 6 companies that are really serious. And those seem to be the ones that are catching attention now. Do you think that that's one, Pat, I don't know if you had recognized that, but Mark, do you think that that's a trend that we're going to see continue in the future, even if we get a more bullish market where there's a lot more investors coming into the space?
Well, I do, Alan, because let's go back to the time period between 97 and 2002. People seem to forget that wasn't exactly a particularly good time for the venture market. In fact, we're back down to those kind of levels.
It was brutal.
It was brutal. And if you go back to 2002, and I go back to those days when I was one of the fairly original guys in terms of being interviewed on BNN, and people were saying, boy, you're pretty optimistic. But on the other hand, what we all started to realize was that originally the companies that had some production that could move forward were the guys that people were buying. What I found on the uranium space, Alan, is that the real rush came in 2006, 2007, because in 2002 we were sitting at like $20, and by 2007 we got up to $130. Then people are trying to tell me they can find uranium in places I've never heard of. So that's pretty much what transpired. So unless we get a real spike in a number of these commodities, I think, yeah, you're going to have to be more selective than, say, frankly, 2006, 2007, you could have bought a lot of things that I wouldn't have bought and still made a lot of money.
Right. Right. I'm
Okay, but
just thinking.
here's the thing. You used an interesting term, Alan. You used the term consolidation. And sure, there are fewer entities out there, but is the industry consolidating? Are the big guys or the medium guys buying the smaller? Is that going on? I haven't seen much of that, but maybe I'm missing the bottom end.
That's a little bit difficult to see happen, Pat. I think you really have to put things into context. But when the time that Mark was talking about after that 2002, and when things really got a lot stronger, there was a tremendous amount of consolidation in the business. You lost Placer Dome, and companies like that are no longer existing because of all that consolidation. So there's a smaller there basically the middle cap mining sector has been decimated. There's nobody in that space anymore. They were all taken over the last go around. So there's less of that. What I was meaning more is consolidation of the focus, Pat, where investors are starting to get a little better at allocating capital, and instead of chasing some moose pasture project in Saskatchewan, they seem to be looking at quality more, and I like that because that's what I've always been about. I've always been about chasing the drill rig, watching the drill holes. I see you nodding over there, Mark.
Yeah, no, it's interesting because this discussion is very interesting because I see both sides here. Look, I think there's still, unfortunately, I give everybody credit for trying to run their own mining company. I couldn't do it. But there's still too many people on the exchange that probably shouldn't be there. There's like 400 guys right now with less than $200,000. And some of those will be okay, but a lot of them, they got to wonder how they're going to survive. But you make an interesting point, Pat. When I was in the oil and mining industry, in my days at Gulf and Chevron, I could never figure out why we didn't buy people at the bottom of the market. But that's not human nature. People tend to buy when things are better. So, I mean, if I was running the company right now, I'd be out there looking for these opportunities, but it's not seemingly human nature among a number of people. So you're right, Pat. The number of takeovers has been limited.
It's amazing because I've seen the same thing over the years, and they will always pay up. And you would think that mining companies that have, teams of geologists that can look over this stuff. I mean, I was talking to Pat in the early days of Gold Eagle getting really good results, and Pat and I were on BNN several times talking about it. And I knew that thing was a takeover, just like I know that Fission out in Saskatchewan is a takeover. But right now, Fission's trading at about $1.25, and they will probably be a takeover at $3 when the uranium price starts going up again. It's amazing, Pat, that these major mining companies, they're like the average investor. They gain confidence as these things go up in price. Mm. I'm a bargain hunter. I'm like Mark. I'd love to be sitting on a big checkbook right now and out there grabbing things because, well, I don't have a big checkbook, but I have been doing that lately. We talked a little bit earlier about the companies, a couple of companies that I'm involved with, one in diamonds, one in gold. So I see these opportunities out there, and I think now's time to be getting aggressive when everybody's sort of licking their wounds and talking about the blood all over the street.
But Pat, we can go back to some of the stocks we put on Sun, and over the last year and a half, we had about 8 of them that got taken over. Now, when you consider all the ones we put on, it was still a pretty small number. But Alpha was one of them by Fission, for example, Strathmore and Uranium. So there were some takeovers, but in some of those cases, they had such fabulous results that attracted interest and people walked in. But I see companies trading. Primeline Energy trades at 1 times cash flow. I mean, now I realize a billionaire owns over 50% of the stock, but nevertheless, I look at that and I say to myself, how do those valuations actually happen in this marketplace? And there are other companies like that here in Canada that I'm starting to see, though, people are starting to pick up the phone from various other countries and say to me, hey, Mark, what do you think of the valuations in your country? And I'm saying, hey, there's a lot of pretty cheap valuations out there. So we might see a changing trend. I don't know if the Shell takeover is going to make a whole lot of difference in the short run to the oil industry, but it's going to at least open up some eyes to people that there are a lot of very well-valued companies here in Canada, especially if you believe oil prices are going to recover over time.
So the thing from both of you is sell America and move some of it back into Canada?
Or Canada, Australia, New Zealand, Europe, Asia, anything but the U.S. dollar and U.S. equities right now for me.
Well, I must admit, I even bought, and I think I own one ETF in my life, but I own one that's Indian-based, and it's actually doubled now in the last year. So, I tend to agree. I mean, I have been advising people in my own situation. I've been bringing money back here, and I honestly think, I don't think we'll get $20 oil that Citi suggests, but if it should somehow happen, guys, I'm going to load up the truck. I mean, there'll be some people that will breach their covenants and will disappear, but there's going to be other mid-cap oil companies that will be so badly beat up. It's going to be the best opportunity I've seen in probably since 97, 98, and I did pretty well in that time period. So, I mean, I got a lot of friends in the oil business. I'm not hoping for $20 oil, obviously, but I am sitting here right now with a lot of cash looking for these opportunities.
And I'm a bargain hunter, and I never thought that I would get a chance to be talking much about oil stocks. How they've been over the last number of years. They've been doing very well. I don't chase things. I generally, even for the uranium space, I waited until after the $150 peak,
right,
and then I waited until all the dust had settled and found those that were high quality. I'm actually doing that right now with oil, and I didn't think maybe in my career I'd get a chance to do this, but these things have been just decimated. They've been beaten down so bad, and an indication of how beaten down they are, some of these stocks, I was just talking about one the other day, I think it was Lightstream Oil and Gas or Legacy.
Right.
Just a $3 move in the price of oil, and that stock moved 50%, Pat. Yeah. That's how beaten down these things are.
Yeah, people just look for the exits, no matter what.
Exactly.
No, you're right.
So what is your outlook, Mark? What do you think's happening in oil, and where do you think it's going in the next little while?
Well, as people know, I spent 10 years in the oil business. Now, that doesn't necessarily mean I have a better view than anyone else, but it's amazing. Even the cab driver the other day recognized me as being on TV, and he says, I know where oil's going. And I thought, well, that's kind of interesting that everybody's got a view. Hey, I listen to his view because I'm always listening to everybody's view.
What did he say?
Well, he said he thought oil was going to skyrocket, and I said, well, gee, you know what, I hope you're right because I still have positions, but he didn't seem to have any rationale for why it was going to skyrocket other than it's a non-renewable resource, which is true. But I think that in the next 3 or 4 weeks is kind of be where we're going to see the bottom because I think seasonally, once we start to get into the driving season, and I think we're going to have a good driving season given these gasoline prices, particularly in North America. You're seeing gasoline improvement demand even in China. So I think watch the next 3 or 4 weeks. I think we could get back into the mid or even low 40s, and then I think that's the bottom. And I know, Pat, you know this from having been on the network with you a number of times. I've said we go back to 75 at the end of the year. I know Pat's going to probably disagree with me, and that's fine. But that's my view, is that I think we will snap back because, we had a 50% decline in the price of oil. And the elasticities I've worked out over the last few years, minus 0.03, would indicate a bounce back of about 1.5 million barrels in demand. That gets rid of certainly part of that issue. I don't know what's going to happen with Iran. That's another ballpark situation we have to take into account. But I think ultimately, remember, it's a non-renewable resource. So, and the low-hanging fruit has largely been found in this world. So I don't think $45, $50, $60 is a sustainable medium or long-term price based upon my days in the oil business, but that's just my view.
It's not even supply and demand, though, I don't think, Mark. You and I have had the discussion as geopolitics, and they need the price of oil suppressed to keep places like Russia and Iran under their thumb. And I don't see any nuclear deal with Iran or any developments in Ukraine changing that over the short term. You've got a cup of coffee, 75 doesn't see the light of day at the end of the year.
I guess, sorry, but one point to make about that, Pat, but if there's no nuclear deal, I think that might be positive because then Iran doesn't pump the same amount of oil, and the Saudis seem to be, I think the Saudis are more concerned about Iran than they are oil shale producers in the United States. That's just my view. So I actually think that a concrete, some kind of deal might actually not be the best thing in the short run for oil prices.
That's an interesting conflict that you guys have going there because generally I'm a supply and demand guy, and when I see oil trading at significantly lower than the average cost of producing it, I start to get bullish. But then Pat makes a very good point that is this price right now have anything to do with supply and demand? and is it all more politically based and trying to put Putin especially under the thumb? I noticed that he might be getting the message because he doesn't seem to be making as much noise lately. Pat, am I encapsulating your outlook?
That's exactly what I think. It is primarily Putin, but also Iran. Your point is well made. And the argument of suppressing supply out of the United States, that supply is there now. That infrastructure is in place. They can pump it for less than what you assume is the average. Say $50 for argument's sake. They can get it out of the ground cheaper now. It wasn't the case before, and it wasn't the case with it's certainly not the case with a new project in the oil sands. But the infrastructure that's there currently can make money at these levels.
In some places.
Yeah,
I'd agree with that.
I think the oil sands are struggling a lot right now.
Yeah, I mean, Pat's right about any new oil sands projects. Some of the older ones that have been revamped, some of them are okay, some of them aren't. If I look at the United States, it's true there's been some improvements so much in shale that there are guys who can make money under 50. I would turn it over, though, and look at the North Sea. Not a whole lot of guys can make money at $50 there. What's it going to do to offshore West Africa, where there's a lot of drilling that seems to be slowing down? So, you know, there are places where I would agree with you. You can't make money at these levels. And I guess the real question is, at some point, will there be some political improvements out there? I think there could be.
See, Pat, I think what you have to remember that is changed probably in the last 20 years or so is that, you know, we are now going down a lot deeper. We're getting into tougher areas, countries to do business in for oil. They're going deeper and deeper into the ocean to get oil. The oil sands are becoming more of an important source. So what I'm getting at is these are all unconventional. These are all added costs, and they're not the same as they used to be. You know, so your costs have gone up quite dramatically because you've had to go to these deep sources or hard to get to sources.
Where did I hear this argument before? Oh yeah, peak oil. Wonder what happened to that.
Well, you know, Pat, I argued there was peak conventional oil, which I'm sure I'm right about. But you're right. Look, who really thought that you'd get the kind of shale situation you got? I mean, when I was in the oil business, we knew the shale oil was there, but we assumed we'd never get it out. And then, of course, the technology changed. So you make a valid point. The peak oil guys, and we won't mention any names, but there were guys out there talking $200 oil when I couldn't believe when we got to 147. So, you know, it's all relative here. I mean, I just know at some point in time, I believe that being a non-renewable resource, and it's a transportation fuel, we're now up to 100 million vehicles being produced a year in the world. So I think over time, I mean, I might be wrong on my timing, but I think that if you're a patient investor and you buy oil stocks that are decent quality in the next few months, you'll do okay over time.
And I like that call. You know, I'm a contrarian. I'd rather be in early than late, and you know, so you don't get the best price. I think you're getting very good prices right now. That stock I mentioned, Legacy, just in a matter of a day or two, popping, I think is an indication of how pushed down these. Now, having said that, I think you got to be careful in your selection. One of the companies that I like a lot in the oil space is Chinook Energy. They seem to have a management group there that you know, keeps an eye on the bottom line. And while everybody is cutting exploration and they've got their finances under control. Another one I think that has a good balance sheet and good management is that Torc Energy, TOC or TOG.
Yeah, TRC. Yep.
TOC. That's another one that I follow and I like. What are some of the oil ones, smaller cap oil ones you're following, Mark?
Well, actually, that's interesting you mentioned those two because those are two we had recommended recently as well. And you already gave good reasons for why we like Chinook and Torc. I mean, Spartan's one we've owned here in the last few months. That's a great management team. You know, we've been also even looking at some of the service companies. Now, we're not going to buy them yet, but we know that that's really a leverage play at some point. And again, your point's well taken, Alan, because when you mention somebody like Legacy, the issue there you have to remember is pretty big debt. So if they can survive through this next little while, and I think they probably will, then it's an interesting company. But you have to be careful about the guys with the big debt. I'd be a little cautious about jumping into a few of those. I mean, D3 is another one that we follow. You know, a great management team, and you know, again, some of these have been beat up, but some, again, look at the debt issues more than anything, and look at the management team and the cost of production to get an idea of what you feel comfortable with.
You think this is, what do you think of that strategy, Pat, to be buying bargains here, even though you don't see $75 oil by the end of the year?
I'd wait to see the whites of their eyes. You pop through 55, just to pick a number, then maybe you've got a real argument.
So you want to see it break out above 55?
Yeah, oil prices to break out above 55 before I look at the space. I mean, I'd rather be, and it sounds to me like you guys want to be a little bit on the early side.
Yeah.
Well, I'll put it this way, Pat. You know, I would still argue, given I'm an oil and commodities guy, I'm probably in my own portfolios even a bit underweight, if we're going to be honest. However, you know, as I said, if I saw oil weaken in the next 3 or 4 weeks, and I see some sell-off in these, I'm certainly going to nibble, because I don't expect to hit the bottom. But I understand your point, Pat. A lot of people want to pay a little more when they know a little more and they feel more comfortable, and I can appreciate that, because I think $55 oil will be here sometime in the late summer. But you know, everybody has different investment strategies. I just think anybody who's thinking they're going to make a lot of money going short right now, I'd be very careful.
Yeah, and I think Mark makes a good point there too, Pat. It's not like we're you know, we're banging on the desk telling everybody to go fill up. It's just one of those things that I think, you know, you can start to nibble, take positions. You know, I like it when oil's trading below 50. I see the stocks that seems to be a sort of a mental number for a lot of traders in the space. So I see some real bargains at under 50, and I just think you've got an opportunity there to take advantage of those bargains, and you don't have to be in any hurry, is what I'm getting at.
Yeah, but
what's interesting, Pat, if you go back, Pat, if you go back to you and I did last year, and you were saying, oh, you're not as bullish at $100. Now, I don't tend to buy oil stocks at 100. Now, admittedly, you were more bearish than I was, Pat. I'll give you that credit right now. You suggested $70 was very likely, and I thought 75 to 80 was more likely. But, you know, it's interesting because you picked up on the fact that I wasn't buying a whole lot at 100. Now, I wish I'd said 50, but obviously I didn't. So, but I was fortunate because oil prices fell so fast through 75, I couldn't position. So, you know, sometimes you're fortunate in the situation that went down so fast, I just stood back.
Yeah, they're just numbers out there, and as I say, the geopolitics play into it as much as anything. But I assume then, Alan, you're bullish in buying a lot more if oil hit 20.
Oh, yeah, if it hit 20, Pat, I'd back up the truck. And that's, you know what, Pat, maybe, and that's a reason why. Maybe you take a 30-40% position. And by the way, Pat, I'm not sure that those stocks would get beaten up quite as much as you think they would.
And I also don't think that they would get the same pop if it goes through 55. I think you have time.
Okay, fair enough. And that's why I think either way, you want to take a sort of a 30-40% core position kind of attitude. If it breaks down, you add to your position. If it pops up, maybe you take a little bit of profit and you trade around that core position. That's the kind of the kind of strategy I'm looking at here.
I think that's a really good strategy, Alan. I mean, I think you're absolutely right, Pat. I mean, if the price of oil went to 20, the margins on gasoline probably would increase somewhat. So a Suncor, for example, is not going to get beat up anywhere close to the price of oil going down. I do think the guys with big debt problems, whether they would survive, becomes another issue.
No.
And therefore, you'd have to be careful. If you're going to bottom fish on those, you might end up one day and realize that the covenants are breached, the company's gone, or there's going to have to be a big restructuring. So that's where $20 oil, you'd have to be very careful. I think on the mid-cap guys, if they get beat up a lot, there is the chance for them to bounce back somewhat. But I agree with you, the big guys won't go down nearly as much.
A legacy to me, Mark, is more like a trade.
Yeah, that's right.
Like a Chinook and a Torque. those are fundamental plays to me. Good
I
management.
completely agree with you.
You know, they've done a good job with their bottom line. In the case of Torque, they didn't, Pat. Well, every other oil company is slashing dividends. They haven't had to slash any dividends. That to me says that that company is well run by a group that understands the bottom line. And even though Chinook's small, they're in a similar boat. I think they've got well-run companies. So, you know, legacy is something you might want to trade here.
I agree. I agree.
Something I think you want to be a shareholder of.
No, you know, that's great advice, because I probably got about 15 or 20, and they're probably the same companies you like, Alan, that you mentioned. Torque, we mentioned Spartan, Crescent Point on the big side, where, you know, the dividend is pretty safe, and I mean, even with these fairly high yields. So, you know, you're right. If you're going to take the more speculative ones, then play them as a trade. And even if Pat decides to buy those when they're through 55, my advice would be the same. If the price of oil went to 60 and you got a pretty good profit on something that's still relatively speculative, take some of the money off the table. I think the thing that always drove me crazy, Pat, I'd go on TV, I'd make a recommendation, stock would fly up, sometimes come back for various reasons, and people said, "Oh, I didn't make any money." You mean you didn't sell anything? And it's just, you got to be willing to take some profit off the table.
Absolutely, absolutely. And you know, Pat plays a host on TV, but he's not too shabby when it comes to analyzing this stuff either.
Well, I think that, Alan, you got to remember, Pat was in the industry for a long time before he became a TV star. So I think you got to remember that his you know, and I'm not saying this in deference to anybody who's on TV, but you know, it's always interesting to see the people that came from the street like Pat, as opposed to maybe somebody that had a little bit more of a traditional journalistic background. You're going to get asked different questions, and individuals who've worked on the street like Pat have an understanding that, you know, maybe somebody who came out of a journalist school doesn't quite have the same understanding. I mean, I'm just being fair about that.
Absolutely.
Well, all three of us were there when it was $10 oil. We remember it well.
Isn't that?
Well, you know, I was in the oil business, Pat, and that's the reason Chevron sold the Canadian assets to Petro-Canada, and I won't go into what that necessarily did to me personally, but that's the way it goes sometimes.
Hey, before we close it off, guys, gold. What's everyone's thoughts on gold these days, Pat?
It's really offside on gold. When it moved up to $1,300, I saw support at $1,250, and it blew through that so quick, and $1,200, and then $1,150. So it's a really fickle marketplace. What are we hovering around $1,200 right now, give or take, right. A little bit. I think we're down $9 as we came into this conversation, just above the $1,200. I think you really have some support there, but was 6 months ago.
You know, it's interesting, Pat. I give you credit because I think your forecast over 1 year was within a couple of bucks. You were almost dead on at the end of 2014 because, as you know, we were talking those forecasts for years on the networks. And I think we're going to see some improvement as we go through this year. I actually have $1,300 by the end of this year, and I'm over $1,400 next year. And it's not just the dollar issue, but I think that, frankly, the jewelry demand is picking up in India and China. The present government has cut that import tax in India. I think they're going to cut it again. I mean, I'm very positive about the present Prime Minister in India. That's something we didn't talk about before, but I think that he's one of the best things that's happened to India in a long period of time, and he's very positive for growth and ultimately commodities. So I'm hardly the bull that some of the guys on the street are that probably still have $2,000 in a couple of years, but I am more positive than, say, the big U.S. banks. Some of them still talking $800 gold next year.
In my case, I think that we've seen the bottom in the price of gold. I think that we're going to go into a more positive trend. I don't think that that's going to be any runaway back to, you know, real bullish attitude in the market. I do think that there's going to be some more better selection by investors of sticking to quality. And I also see a similar thing with gold stocks that I see in oil stocks. They've been beaten down so dramatically that it doesn't take much for them to move up 30-40% in days sometimes. And so you know, those are. I'm bullish on gold from here, and I think you want to stick to quality. Some of the companies that I'm really bullish on, Rubicon right now, Rubicon will start producing gold in Red Lake, Ontario this summer. I'm also very bullish on Premier Gold. Premier Gold just did a deal the other day for buying off Goldcorp, a $20 or $30 million asset in Nevada. Those are a couple of the gold ones that I'm very bullish on. Are there some you're taking a look at these days, Mark?
Well, it's interesting you mentioned Premier, and Pat will confirm this. That's been, in the last 2 months, that's been one of my top picks. I've known Ewan Downey for a long period of time, who runs Premier. In fact, we go back to the days of Wolfton, the original Wolfton, which was a big takeover and very successful for those of us that mention it on BNN. I mean, I think Premier is a prime takeover candidate as well. As good as the management team is, it's a great asset group there. For disclosure purposes, I do own Premier at about the 175 level, and I'm holding it. I think it's a great play. I own Detour. I do follow Rubicon. One of the ones I now follow that I know, I mean, Kirkland Lake I've been back into ever since Eric Sprott got heavily involved. And I'm also involved in another one of Eric's plays, Barkerville. I know that in the past there was some issues there with the previous management, but, you know, Eric's gone in along with other people, and they've changed the whole management team. I think there's really an exceptional opportunity there. I bought the stock at 13 cents in the sell-off in December. It's now trading around 25, 26. I know there's people have been in there for years at higher prices, and there were issues with the regulators in the past, but, you know, this is a different story now. So I think that's kind of an interesting spec if you want to play a speculative play, Barkerville, of course, in British Columbia.
What's your feelings on gold these days, Pat?
I'm not buying any gold stocks yet. Again, I'll wait to be seen right.
You want to see some confirmation that the what is that sort of catalyst, or not catalyst? What's that level you're looking for, Pat?
1250. So I'm not as high as 1300 by the end of the year. I'll probably be in the 1275 range. But if we get towards 1250 and hold it this time, I mean, like I say, I thought that was the real support area, and we didn't get it. So now it becomes obviously a resistance area. You pop through 1250, then you might get the run that Mark's talking about. But I don't know whether you get through that 1250. So I'm going to wait until I see that another $50, $60 to the upside.
Well, that's a good point, Pat. 1250 is clearly resistance. There's no question about it, that 1245, 1250. Again, I don't mind having at least a partial position, Alan. That's what I've done. I mean, I haven't backed up the truck. I'm kind of like Pat in a sense. I do think we're going to, I think we're going to go through the 1250, Pat. But, I mean, the proof will be in the pudding. But, you know, there are a few that I'm going to be positioned in right now because I know that even if I go to 1240, they're going to move somewhat. But maybe some of the other guys that I think need something closer to 1300, 1350, I'm more likely to buy those after we get through 1250 as well. Because, again, I'm not going to sit here and tell you I'm overweight in gold. I'm not. And I probably won't get overweight, but I certainly could get up to at least what I consider a neutral position here in the next, say, 3 to 6 months.
I've been trying to look at it sort of, you know, I try to find things that right now could make sense even at these prices.
Yeah, and there are the ones that do.
You know, Rubicon makes sense at these prices. Midway, they're going to be a new low-cost producer in Nevada as well, MDW. That's another one that I think you want to take a look at. But, again, it comes down to quality and just being you know, reasonable. I mean, they say you want to buy low and sell high. Well, first you got to buy low, and are we as low as we're going to get? I think we're pretty darn close to it. These things have been, the stuffing has been beaten right out of these things, Pat. You look at the venture exchange, it's at record lows right now, and there's still about 600 companies on there that could go by the way of the dodo bird. They, like Mark was saying, they don't have enough capital for listing requirements. So, you know, I like to look when there's lots of blood on the street, and there's definitely that now. But I do appreciate what Pat is saying as well. You know, maybe some people like to wait for a little less blood on maybe when the Band-Aids are starting to go on. I think that's what you're saying, Pat.
Well, quality will prove out over time, and if you're buying quality, then you should be fine. But you're not going to have interest in the sector, and that's what you need to get the prices to run. You need interest in the sector. I'll get in when there's interest in the sector.
Well, and I think that for somebody who's less speculative, a little bit more, I won't say really conservative, because if you're buying kind of junior mid-cap gold mining companies, there's certainly some risk there. But, Pat's point's well taken, that if you are an investor and you don't think you can catch the bottom, which a lot of times you probably can't anyway, if you really feel like you want to wait till you feel a little bit more positive, I don't have a problem with that. I mean, I've been around a long time in the commodity sector, and so I'm not afraid of being a bit early. I mean, as our good friend Mike Vaughn said to me in 2001, continually through that year, Mark, you're too early. I was too early. But, ultimately, if there were other people that got into 2006 and 2007, they were too late. So, it all depends on your particular risk profile, too. I think that's important to recognize, that I don't put all my money into one area. We mentioned Probe as a takeover on the network with you, Pat, and a guy phoned me up. He said he put half his portfolio in that. I'd never do that. Now, he ended up making a lot of money in the takeover, but that's the kind of thing sometimes people do, and that's why I'm always a little reluctant sometimes to say, hey, I like certain stocks, guys, but don't go crazy. I never own more than 4 or 5% of one company in my portfolio.
Yeah. So, as we were talking, guys, I think it's one thing that I really like is that, back when we were on TV, you always have to worry about commercial breaks and how long things are going. One thing I like about this online stuff is we can really dig deep into stuff, and I like doing that. Before we close, guys, any last thoughts, Mark?
Well, I would say again, I always advise people that if you're going to be a stock picker and you're going to do more than just buy ETFs, follow your stocks continually. You got to be on top of them daily, because there's always things that can transpire. Stay with better management. Stay with better jurisdictions. That's what I've always done. I never say countries I don't like, or I don't short companies on TV. I don't do that. But people have said to me, gee, you seem to stick to certain jurisdictions. Absolutely, because I don't need to wake up tomorrow and have a surprise. And I do think one commodity I think is going to do exceptionally well is zinc. And I'm actually doing my blog this week on it. I'll be putting it out later today. I think the zinc opportunity there is great, given the fact that, do you realize the two biggest mines that are shutting in the next year are equal to all the inventory right now on the LME?
Yeah.
Okay, so against that background, Alan, to answer your question about outlook, Michael, so you guys are micro guys, and you look from the bottom up, and that's great. That's one approach to the marketplace. My concern is what happens to the markets when interest rates change, and they will change in the United States. We know that's coming. How does the market respond, whether it's commodity markets or stock markets? That's what I'm looking at.
That's an interesting point, Pat, if I could just interject for a second, because one of the things I went back and checked in history, now it may not be a perfect example, but when we had those rising rates in the 70s, money left the long end of the market, then left the short end of the bond market, and where did a lot of it go? It went to equities and commodities. I'm not suggesting that's going to happen again necessarily, but I mean, I got to be honest, I own 0 bonds personally, and we have 0 bonds in what we're recommending. Now, I know some people say that's wrong, and I know, Pat, you were a fixed income guy, so I'd be interested in your comment there. But I have 0 bonds because I agree with you. I just don't think that, I mean, these guys were buying Swiss bonds at negative interest rates. I don't understand that. I really don't.
Yeah.
I've had a hard time wrapping my head around that too, Mark. But I think what it basically comes down to is some of those people have so much money that they don't care about the loss of purchasing power. They just want somewhere safe to park their money.
Yep.
Perceived to be safe. What do you think, Pat?
I'm probably running around 50% bonds still.
Really? Okay.
It hasn't hurt me.
Are you more corporate, Pat, or?
I've been doing it through ETFs, oddly enough.
Okay.
I have a blend of corporate as well as government bonds, and high yield as well. And I've been shifting more down the corporate line, if you will.
Yeah, okay, that makes sense to me, because we should make that distinction to people that, corporate bonds do tend to act more like equities than regular bonds. I guess so. I should point that out, that I happen to be out of bonds.
When I'm talking about bonds, it was the government.
Yeah. Me too. Yeah.
So, well, I think we gave them a lot today, guys. On that note, let's wrap it up. Again, Mark, thanks a lot for coming on. We're going to get you on again in the future, I hope.
Oh, absolutely. You know what? This is terrific. It's always good to see you, Alan. Great work you do. And, you know, I've known Pat for years at both BNN and Sun Network. And hopefully we can continue this and see maybe another network that pops up and we can do this all again. So.
Well, the nice thing about the internet is we can be our own network.
Oh, that's really true. You know, I really like this, Abby. As I said, I got into the 21st century today, so great for me.
And you know what? We're actually live right now. Some people can watch this live, so it literally is a network in a box these days, Pat.
Absolutely, Alan. Looking forward to the next one.
Excellent. Well, thanks again for joining us, Pat and Mark. It was been a great show. On that note, before making any investment decisions, it's important for you to do your homework, speak with your financial advisors, including your wives and your husbands. We don't want any divorces or anything because of our picks. Mark already was worried about one guy putting his whole portfolio in one of his picks after watching them. Do your homework, speak with your financial advisors, and have a wonderful day. We'll talk to you soon.